Me for the hour this Friday, Bryn Talkington, Jason Snipe, Jim Lebenthal, John Najarian, the co-founder of MarketRebellion.com. Let's go to the wall, take a look at where we stand. Noon in the East. Dow's down 456, 1.33%. The S&P is negative as well, 4,300, 4,400. That's kind of the channel we feel like we're in. 44 is resistance at the top. Haven't been able to really break below 43-ish. 100 on the S&P. It's a loss of 1.5% today, and yields continue to decline as we do have that flight to safety, a flight to quality, a flight to just make me feel a little bit better. 171 is the note on the yield on the 10-year note. So, Bryn Talkington, people are trying to get more bullish. We had Citi yesterday upgrading U.S. stocks to overweight. Today I've got FundStrat's Mark Newton. He's their technician. The near-term uptrend for U.S. stock indices remains intact, he says. Higher prices look likely into March FOMC meeting. RBC says we still see a path to 50-50 for the S&P 500 into year-end. That's 5,050. What about you? What do you see?
I think that you have to remember, there's no bad weather. It's just bad wardrobe. And I think when you look last year, investors need to look outside and understand what the weather's like. And when we had such low volatility last year, Scott, we knew that we were going to have higher volatility. Forget Russia and Ukraine for a second, just because what the Fed was doing and with quantitative easing, with quantitative tightening. And so I don't think we're in this, I feel we're not, in this March, April of 2020. And so I think these analysts calling for, go back into the market, so like a March of 2020 in April when we had this big V shape, that's just not the market we have. We have midterms, we have Fed tightening, and then we also have obviously the travesty that's happening in Ukraine. And so I think when you also have, a third world country with first world nukes, I mean, Scott, when is the last time we've all had to have and digest that type of conversation? And so what I think is important for investors is that if your whole portfolio is based on interest rates moving lower and capital appreciation only on your stocks, I think this is going to be a tough year. And so that's where I think, I've been talking a lot about covered call strategies. We express that via JEPI or individual names. And you need to have some other components like dividends, like covered calls. They're going to get you through these periods of volatility and not just be focused on, is PayPal going to go back to 200 by the end of the year? Mm-hmm. That's not the kind of market we're in right now.
Okay. You're not the only one saying that. And by the way, when you say the analysts are suggesting now's the time to buy stocks, it's not just the analysts. It's one farmer in particular at the bottom left of the boxes of the investment committee today who suggests that now's the time to do the same thing. Jim Lebenthal told us we're going to have to dust off the moniker All In, Mr. All In again, and he said he's going to be buying stocks again next week. That's a big call. Is it right? Is it right? Because Bryn says this is not the kind of market that we're in to make those kinds of calls. Josh Brown suggested the same thing yesterday and said those who are buying the dip are getting punished, not rewarded. Here's what Josh said, and I'm going to give you a chance to respond on the other side, Farmer Jim.
The dip buyers are getting killed every time they go rushing into one of these earnings blow-ups, and there have been like a million, and they get that up 6% the next day and then back down to the lows and then lower 2 days later. That weighs heavily on sentiment, and I think we're getting to the point now where you really don't even have any good reactions to good earnings. Like you get an hour of a green stock, and then within a day or two, almost every name I could think of off the top of my head, good, bad, or indifferent on the earnings side, is lower. That is a sentiment shift. Pick up on it. Pay attention to it. It's telling you that you don't have to listen to Citi or anybody else that wants to make a grand pronouncement like, all right, I'm back to all in. This is the wrong environment for that.
Okay, Farmer Jim. He says your call. He basically says your call and calls like it are ridiculous.
Your Honor, I thought that was Big Farmer, but we'll just move on from that. Look, I heard it yesterday, and I heard Josh when earlier in the week he said this was a bear market. I think Josh will be the first to admit that he and I have different investment styles, but to both comments that this is a bear market and that buying the dip has been wrong, what I say is you're in the wrong stocks. Okay. I mean, for people who have focused on fundamentals, who have focused on price, and who have said all along that valuation matters, this is not such a terrible time. First off, the S&P 500 is in a slight correction here. We're a little down. We're down a little bit more than 10% from the high. But if you're in the value and cyclicals, the industrials, the energy, the materials, the financials, you're not feeling that sort of pain. You're just not. If you're in the ARC stocks, you are feeling that pain. I understand it. It feels like a bear market.
He's not in the ARC stocks. What are you talking about? He's not loaded up. He's not loaded up on ARC stocks. And if you've been in the financials, you've been feeling a lot of the pain. I get where the S&P 500 broadly is. Okay, it's 10% or so off of its high. That doesn't even begin to tell the story. 38% of the S&P is in a bear market. 70% is down more than 10% from its highs.
You know what, Scott? Those numbers, 38% of the S&P 500 in a bear market, have been much higher just last year, much higher than 38%. So that doesn't faze me. But to the comment about buying the dip and you get your face ripped off, no, you don't. Just look at Paramount. You and I parried about this 2 weeks ago. It was down 20% after earnings. I said to buy it. Guess what? It was the right thing to do. Cleveland Cliffs was down 10% after earnings. I said to buy it. Guess what? It's the right thing to do. This is a question of what stocks you're in. And I'm sorry, if you're in the wrong stocks, it feels terrible right now. If you're in the right stocks, and not even just the right stocks, I own Twilio and PayPal. I just don't own very much of them. And put it all together in a diversified portfolio, this ain't so bad.